Welcome to QLM Business News. And now for today's news stories. Is the United States truly on the brink of a recession? In recent days, global stock markets have been in turmoil. Trading screens across the United States, Asia, and parts of Europe are flashing red, indicating significant declines. The sudden downturn is attributed to growing concerns that the US economy, the world's largest, is slowing down. Experts pinpoint the release of disappointing US jobs data for July as the main trigger for these fears. However, some analysts argue that talk of an economic slowdown, or even a recession, may be premature. Mixed economic signals. The latest figures present a mixed picture. On the downside, US employers added only 114,000 jobs in July, far below the anticipated 175,000. Additionally, the unemployment rate climbed to 4.3%, a near three-year high, activating the SARM rule. This rule, named after American economist Claudia Sahm, suggests that a recession may be imminent if the average unemployment rate over 3 months is half a percentage point higher than its lowest level in the past year. In this case, the 3-month average was 4.1%, up from a low of 3.5%. Compounding these concerns, the US Federal Reserve decided not to cut interest rates last week, unlike other central banks in developed economies, such as the Bank of England and the European Central Bank, which have recently reduced rates. Although Fed Chair Jerome Powell hinted at a possible rate cut in September, some speculate that the Fed may have delayed action for too long. Lower interest rates generally encourage borrowing and can stimulate economic activity. If the economy is already slowing, there is fear that the Fed's inaction might be too late. Tech sector and market reactions. Adding to the anxiety is the performance of technology companies and their share prices. A long-standing rally in tech shares, partly driven by optimism over artificial intelligence, AI, has faltered. Last week, Intel announced it was cutting 15,000 jobs, and rumors surfaced that Nvidia might delay the release of its new AI chip. Consequently, the Nasdaq, a technology-heavy US index, plummeted by 10% on Friday after hitting a high just weeks earlier. This significant drop has heightened market fears. Neil Shearing, Group Chief Economist at Capital Economics, suggests that if stock market panic continues and share prices keep falling, the Fed might intervene with an emergency rate cut before its September meeting. Such a move would be considered if a market dislocation deepens, threatening systemically important institutions and broader financial stability. Optimism amidst concerns. Despite the worrying indicators, some experts remain cautiously optimistic. Claudia Sahm herself, speaking to CNBC, stated, "We are not in a recession now, though the momentum is in that direction." She believes a recession is not inevitable and that there is ample room to reduce interest rates. Others are more nuanced in their interpretation of the jobs data. Neil Shearing notes, while the report was bad, it wasn't that bad. He suggests that Hurricane Beryl might have contributed to the weak payroll figures for July. Furthermore, he points out that other data indicate a cooling labor market but not a collapsing one, with no significant increase in firings and only a modest decline in average weekly hours worked. Simon French, chief economist and head of research at Panmure Liberum, urges a broader perspective. Have we suddenly reappraised the health of the world's biggest economy? No, and nor should we, he says, acknowledging that while the data points to concerns, it does not definitively signal an impending recession. This news story is brought to you by QLM Business News, your digital media channel. Visit qlmbusinessnews.com for more business news stories. Also follow us on Facebook, X, and YouTube. To help QLM Business News bring you more news stories like this, please like, share, and subscribe.